bit, but we've got ASHWIN Parekh, who's national leader of for global financial services at Ernst Young, joining us on the phone line. ASHWIN, we have the final guidelines out, not very much different from the draft guidelines, but the big climb down, it seems, on the part of the Reserve Bank of India is that it has not said that companies with an interest or with revenues of more than 10% from either construction, real estate or broking cannot apply for a banking license. So that seems to be a big climb down, under pressure possibly by the finance ministry. What would your initial reactions to the final guidelines be?
Yeah, see, I mean, my submission would be that, we will certainly have a situation where there will be a lot of aspirants, there will be a lot of people, who may wish to now apply for the banking license. Earlier, of course, the interest was there, but now on account of this particular climb down, even people who have a large presence in real estate or in the broking business can also apply. So can therefore, to that extent now, the regulator will have to, or the committee that the regulator will form, will have to really evaluate the applications, in terms of any contagion risk that, the presence of these people in speculative business can bring about. So that perhaps the filter or the filtration of the applications will perhaps take place at that stage. I'm not certainly expecting, 150 or 200 people to get licensed. And so to that extent, that part of the evaluation will now be done once, let's say, people have applied in keeping with the guidelines.
Sure, but ASHWIN, the last time around, which was nearly 20 years back, when the first round of licenses were given for private sector banks, the number of applications even at that time were fairly large, given the progress that the economy had made at that juncture. This time around, there are various numbers being thrown around. There is a view that you will have a minimum of 100 to 150 applications going to the Reserve Bank of India. Not necessarily that many licenses will be issued, but 100 to 150 applications, is that a reasonable number for us to be talking about?
That would be a very reasonable number because, the reason is very simple. To begin with, what will happen is, the earlier two guidelines, since they did not allow the business houses to apply, so to that extent, even when we had 150 or plus kind of applications last time, well, when I say last time, we are talking about 1992, when the first time it was opened up, we can certainly look at a much larger number of applications this time around because a lot of entrepreneurs have grown to a size where the minimum capital they may be able to put up, they may have their own plans, in going into smaller markets, they may have their own plans in regards to banking. So, from the aspiration point of view, I would say it's difficult to draw a line, George. So.
Right. Also, ASHWIN, in the draft guidelines, one of the points listed out by the Reserve Bank of India was that the bank will have to be listed within 2 years. I'm trying to find something on that front, but that's the final note seems to be silent on that front. Would you say that that's actually a good idea on the part of the RBI, because for a new bank to list within 2 years is a bit of a challenge?
Yeah, see, there are two parts to this entire aspect. One is whether the promoters would really be able to, take their equity to the market and will they get the kind of price for all the effort that they put in. That's one aspect. The second aspect is unless some element of or some clarity, either in the guidelines itself or the new set of regulations that will follow, I suppose unless there is some clarity in regards what is the time frame over which they are supposed to do that. Now last time, for example, we all know that the conditions which were associated with the approval talked about the period over which the promoters were expected or required to dilute their equity. In the absence of guidelines, and in the absence of the enabling powers, it was difficult for the RBI really to require the promoters to dilute their equity. In that sense, I would say the challenge will continue. In the sense, if there is no clarity right at the guideline stage or at the regulation stage, then how soon would the promoters be expected to dilute their equity, or can they really continue with their equity as long as they wish to, is something that will have to be now examined, George.
Ashwin, also in the final guidelines, what the RBI is also saying is that the NOFHC and the bank are not to have any exposure to the promoter group. Also, the bank cannot invest in equity or debt capital instruments of any financial entities held by the NOFC. Would you say that this is a little stringent, because earlier the expectation was that the bank would not be allowed to do that, not the NOFC? So would you say that this is actually a sound decision on the part of the RBI? And again, does this in any manner disincentivize a number of corporates to enter banking now?
No, a very sound. I mean, this is at the best the minimum requirement. At best is the minimum requirement that can really happen, on this particular part. Because otherwise, we will perhaps go back to the same reasons why, the nationalization of the banking companies had to be carried out earlier.
Back to you, and Ashwin, I want to ask you that same question, because I'm asking you this question in context of what foreign banks have tried and failed at, in terms of, they're being forced to take up licenses in smaller centers, most of them not being able to make much headway in that space and having to actually throw up their hands and say that this is not a game we are capable of playing.
Yeah.
In such a scenario, are we talking about these new banks having a smaller bank, so to speak, within the larger bank in order to, create separate cost structures that can address those unbanked rural centers and make it feasible to operate in those centers?
No, I mean, see, there is one thing which is getting clearly established, and that is, the dynamic aspect about this guideline would be perhaps, that people will have to start looking at those points, where the income generation and the saving generation is high and where the banking density is not there. So, I mean, quite clearly we're talking about a different kind of banking altogether. Now, there are two parts to that new banking. One is, the liability creation or the deposit taking. But more significantly, the challenge will also be on finding good assets in those markets. I mean, what kind of assets are you going to build? What kind of banking are you going to do if your branches are going to be mainly focused in smaller markets and in rural markets? And to that extent, we may perhaps see a different kind of banking. Quite clearly, all those aspirants, who've been looking at the banking and licenses with a sense of eagerness, may have to really go back to their drawing boards, may have to really look at their plans and look at exactly a way in which they can make this new kind of banking also viable on one side, and B is what are the new methods that they can bring into this new kind of banking that we're talking about.
Ashwin, just coming back to you, one of the criteria laid down by the RBI is, of course, the fact that the majority of directors on the bank board will have to be independent directors. But, in a country like India, how independent are independent directors? And that's the big question from a governance front that everyone will want to ask.
Well, no, I don't think that is from the good governance point of view, this requirement is very essential to my mind. Now, when we say independence, what we really do mean is, a large body of professionals on one side, a large body of, let's say, people who are not going to be associated with or interested in either the borrowing and lending aspect of the bank on one side, and be not directly or indirectly connected with any interest, that may perhaps bring in any kind of risk into the banking. All along, even if you look at the subsidiarization discussion paper that had come out, the regulator has maintained, that the good quality of board is very essential. A high order, to bring about a high order of governance, and independent directors, majority, so more than 50% of the directors should be independent is an important aspect. George, I do believe, that if you're going to dilute some of your other requirements, particularly, let's say, requirements around real estate business or broking business, for instance, the only thing you can then, from the regulator's point of view, can really rely upon. So we're talking of two things. One is a good presence of independent directors, but also that these directors will have a much larger responsibility, to my mind, to make sure that all the objectives with which the license is being granted is actually being executed, is actually being delivered by the bank. George?
Ashwin, just coming back to you with that same point on corporate houses being allowed to use their brand when they name the bank once they do get their licenses. Would you be in favor of that?
Well, actually, this is something which is very interesting, George. Several clients, with whom we are working very closely on the new banking initiatives, we've had an opportunity of addressing this question. George, my submission is that Basel III requires, under Pillar 2, banks to set aside a substantial amount of, let's say, capital arising out of reputation risk. Now, there is a merit in lending your name in terms of lending a certain amount of reputation and name behind the bank. But at the same time, let me also assure you, George, that name is not going to come to the bank without a cost. You see, because what will then happen is that anything that can go in that brand name, anything that can go adverse will also have an impact on the bank. So it can work both ways. So that's something that people in the past, for example, you will recognize, even when we weren't talking about reputation risk as much as we do today, or we weren't talking, if you look at all the banks before they were nationalized, most of the business houses who were instrumental in putting those banks together did not lend their names to those banks, So it works both ways, George. There is no simple answer to that, to my mind, but in some form or the other, having anything in rigid terms, either by way of regulations not allowing or may not have worked. So I think the best thing that the regulator has perhaps done is kept silent in the new guidelines, basically.
But would you have been in favor of it, Ashwin?
Well, yes, to the extent that, let me articulate my point. If we're talking about some 2, 3, 4 very large, very reputed business houses, I would say that their interest and their commitment to the deposit holders would perhaps be far more greater. In terms of really respecting that liability, really honoring that liability, should, any difficulty in any one of the business cycles may arise on account of any economic cyclical condition. So to that extent, I would say there is a substantial merit. It gives a lot of comfort to the deposit holders, very clearly. But at the same time, let's not forget, that crisis and economic cycles happen, most sectors today are very vulnerable to that. Now, if there is any concentration risk in any of the business house, if I'm in commodities, for instance, or if I'm in steel, or if I'm in something or the other, and if I'm facing an adverse condition, an economic condition at a given point in time, it may have a very adverse impact on my deposit holders' comfort, on their minds, basically. So it really can, George, quite clearly, I take the point that people will have larger comfort with very large names who have very diversified businesses, and we are sure that their risks in other activities will not be brought to the banking companies. But for the others, where there is an element of concentration of risk, things aren't too clear, I should say.
Right. Ashwin, I know we're all getting very excited about the final guidelines on new bank licenses, and applicants have 4 months to apply for those licenses. But realistically speaking, how many licenses should we expect will finally be handed out? Because the last time around we saw something similar happening.
Well, I would say that the kind of banking that we are now going to talk about, with 25% branches in the rural areas, for instance, and there's nothing difficult about this requirement, George, because all along, in case of all the branch expansion in the last 5 years, we have seen that RBI has really required banking companies to go to those markets, the smaller markets. So there's nothing peculiarly different in this guideline about it. But one thing I must mention, it will certainly take any bank, any new bank, anywhere between 3 to 4 years, to really find roots on one side, they become profitable, they become meaningful, and start contributing to the economy. In such a scenario, I don't think neither the economy nor the regulator can afford too many people experimenting all at the same time, trying out different things and some of them failing. The issue is, I mean, with every 100 rupees of liability that a bank has, only 8 or 9 rupees is capital. The balance is deposit holders' money. So, I mean, banking, as I say, is an opportunity, but it's a huge responsibility as well. I've always maintained that. And to that extent, if too many people get the license, then the ability, on the part of the promoters on one side to make it a meaningful venture, and the regulator to keep a keen eye on that venture for a longer period, does become a bit of a challenge,
Ashwin, back to you on the, the foreign holding norm that the RBI has mentioned, saying that it will be capped at 49%. The Finance Ministry was pushing for a slightly higher level than this.
Well, actually, you see, I mean, the past experience shows, that if you take a foreign investor, a strategic foreign investor for that, as your partner in a banking venture, I mean, we have had one or two examples in the past in 1992 when the licenses were offered. The reaction was a mixed one. I mean, they were to play a certain role in Indian banking, but after a certain stage, they stopped playing it. And then in one case, the foreign shareholder almost sold his equity, sold it out to once again Indian investors. So, I mean, it's been a little mixed one. But this time around, I thought that if you're talking about large capital sums, and if you're talking about a certain order of risk, because all said and done, inclusive banking or banking around inclusion, financial inclusion, it has its own risk. I mean, it's not a viable business as yet, and therefore, I thought some amount of risk capital, some amount of equity could have been, a more amount of equity could have been drawn from those foreign investors who are eager to do both the things. I mean, one is they're eager to really put in the investments in India into a banking venture such as this, but they can also bring about some amount of know-how along with their capital. If they are working in, those kind of markets where inclusion is a challenge, then in that case, it could have been a little more welcome. But all said and done, from all the new initiatives that I have, about 8 or 9 new initiatives that people have talked to me about, there wasn't too much of a larger dependence from the equity point of view on the foreign partner in any case, George. So to that extent, I would say it's a welcome one. And if after 5 years it does become in the normal course, like 74%, as it is for the other banking sector, other private sector banking companies, then to that extent, it's interesting. I mean, it's worth looking at more seriously and looking at some possible partners who can bring in the know-how and also the capital, George, which is the constraint of this guideline, basically.
Sure. But, Ashwin, on the one hand, you have the Finance Ministry saying that by not allowing corporates with interests in construction or real estate or broking, you are blocking people out who have the available capital to invest into the bank. That's what they're saying on the one hand. On the other hand, you've allowed up to 49% FDI, or rather foreign investment, in these new banks. So the capital is available. When you've allowed the foreign part, was there a need to go slow on, or rather make those relaxations for the construction sectors, for companies with the broking, with interest in broking, etc.?
You're absolutely right. George, there are 3 things about these guidelines, and if you read these 3 things together, then it does become a little challenging for the new banks. One is, of course, the FDI and the overall, not just the FDI, but also the foreign investment limits, on the foreign investment in a new licensed bank under the new guidelines. So that's one challenge. The second challenge is that these banks will not be able to take their equity perhaps will not be able to take their equity to the market because of the time it takes for them to take the equity to the market. In which case, the additional requirement will have to be really coming from the promoters themselves. And that's a very important point. I'm getting an impression, George, that that's what exactly, this is precisely what the regulator wants. He wants the promoter to really put in his name, put in his efforts, put in his capital, more importantly, work the bank for the next, for these 3-4 years, till it becomes, invite domestic investors in to begin with, and after 5 years invite foreign investors thereafter, and open it up to both the sets of investors then thereafter.
Parekh, Ashwin is of the view that you will see as many applications, So as many applications as you did the last time, and all right. And Ashwin, again, I'm just going to ask you this thing again. This time around, should we expect that the applications will be far higher than the last time?
The number will be higher, but I'm very confident. I mean, last time we saw almost 9 plus 1, about 10 licenses being granted. I can't see 10 licenses being granted in this round. I can see about 4 or 5 at the most.
So Ashwin, Anirudh here from ET Now as well. I'd just like to understand what kind of entities would you actually be looking at which would be kind of applying for this banking license. We've seen a number of names come up in the past in the news, the likes of Tata Capital, Religare Enterprises. Would you have any shortlist in your mind as to which could be the best frontrunners at this point of time?
Well, I mean, I perhaps may not look at that. But I mean, I can certainly say who are the aspirants. I mean, I'm really, for the purpose of my own, let's say, practice evaluation, I'm looking at it in 3 different segments. The pure NBFCs who already are into these kind of markets that we're talking about and who have a sizable portfolio, have a capability of running new banking with a very low cost structure, and therefore they become eligible. Some of them do become eligible. In the business houses, once again, very responsive business houses with huge names, with a lot of excellent, let's say, contribution to the economy will certainly come forward. They're really eligible. The economy needs them to really put good banks, So that's the second category. And you do have in the third category a number of professionals who may perhaps closely with those who are in a position to invest and also to create, some kind of the third one, of course, if they do not have deep pockets, then they can find the whole thing very challenging. But in the first and the second segment, I would certainly see very interesting 3 to 4 applications per segment, I should say.
Right. Also, when the last time around, when we saw the draft guidelines come around, a lot of people were expecting that the final guidelines could actually lead to some amount of M&A play really moving on in the banking sector as far as, the kind of guidelines that could be put out for the new banks. Do you expect any kind of M&A moving in from the side of the existing players as a result of these guidelines?
I don't think so. I mean, the banking that we are now talking about is going to be a different kind of banking. In fact, in that regard, I must admit, the object with which the entire exercise of issuing new bank licenses is being done, let's say, has been very well captured in the new guidelines. We're talking of a different banking altogether. Is it going to really encourage M&A activity? I have my serious doubts, and the reason is very simple. To my mind, if there was some kind of an acquisition, it could perhaps be the acquisition of some of the NBFC units, which can become a part of the bank if they have a sizable presence in those markets where the regulator wants them to and the government wants them to go. So to that extent, there can be some M&A, but I'm not seeing too much of it, quite honestly.
Right. Also, if you look at the capital adequacy requirements laid out in these guidelines, they're saying that they should be at about 13% for the first 3 years of the operation of the bank. Do you think that this is something that the RBI has put out just to ensure that it is something that ensures that banks keep a lot of capital at hand in the very beginning of their operation?
Well, to begin with, I must say, and then this is one area where the Indian regulators really stand head and shoulders above the other regulators. When it has come to capital adequacy, is really, when the Basel norms were at 8% or at 8%, our regulators looked at 9%. The industry average today is around 12.5%, 13%. So therefore, for the new promoters to have that kind of, cushion or solvency or capital base or adequacy base is not harsh at all to my mind on one side. These, it will also in some form, take away, in some, any discomfort that may arise out of cyclical conditions periodically. Lord forbid, and if one of the new banks were to face, some kind of an NPA of a size which can impact its, let's say, capital base, then to that extent some buffer is available, if you see my point.
Right, Ashwin, thanks very much for joining us on the show and so patiently staying on with us these last 45 minutes, walking us through many of those, the implications really of those guidelines for new applicants. We have